Let me tell you something I learned the hard way, and I paid full tuition for it. The market does not reward activity. It rewards judgment. Yet most men who come into trading believe the opposite. They think trading always needs action. They think if they're not buying or selling, they're wasting time. Have you ever felt that itch in your hands when the tape is quiet, that nervous feeling that you should be doing something? I've been there. I lived there, and it nearly cleaned me out more times than I care to admit. You see, the market is a great teacher, but it charges expensive fees. One of the first lessons it tries to teach is patience, and one of the last lessons most traders ever learn is how to sit still. A man can be right about the market and still lose money if he insists on acting before the market is ready. Isn't that a strange business we're in, where doing nothing is often the hardest trade of all? Most losses come not from ignorance, but from action buyers. That's the urge to trade just to feel involved. The tape is moving, the charts are breathing, and the trader thinks, I must do something. But the market doesn't care about your need to feel useful. It moves when it moves, not when you get bored. I used to think that constant trading meant constant opportunity. I believed the more trades I made, the more chances I had to make money. What nonsense. Opportunity doesn't show up every hour. Sometimes it doesn't show up for weeks. And when it does, it announces itself clearly, if you're quiet enough to hear it. Have you ever noticed how the best trades almost seem obvious after you've waited long enough? The real money is not in the buying or selling. It's in the waiting. I didn't make my fortunes by trading every fluctuation. I made them by sitting through dull markets and then acting decisively when the market showed its hand. That takes restraint. And restraint is something no man is born with. It must be learned, usually after losing money. Action bias comes from fear. Fear of missing out. Fear of being left behind. Fear that someone else is making money while you sit there watching candles print. But the market is not a race. It's not a competition of speed. It's a test of discipline. And discipline means you don't trade unless the conditions are right. Ask yourself honestly, are you trading because you see a setup? Or because you're uncomfortable doing nothing? A chart doesn't owe you a trade. A market doesn't owe you a profit. Your job is not to force trades out of thin air, but to wait for the line of least resistance to reveal itself. When a stock is being accumulated, it tells you. When it's being distributed, it tells you. But if you're constantly clicking buttons, you're too busy to listen. I learned early that the market spends most of its time fooling traders. It moves just enough to stir excitement, but not enough to reward impatience. The man who believes trading always needs action becomes easy prey. He jumps at shadows. He buys breakouts that aren't ready and sells pullbacks that haven't finished. Does that sound familiar? There's a difference between being alert and being active. A professional trader is alert at all times, but active only when conditions demand it. That distinction makes all the difference. The amateur mistakes motion for progress. The professional understands that inactivity is often a position. Your capital is your business inventory. Every unnecessary trade is an expense. Overtrading is not ambition, it's poor money management. Would a shopkeeper keep throwing inventory out the door just to feel busy? Then why does a trader burn commissions and risk capital just to feel involved? When you study charts properly, you begin to see that most price movement is noise. The real moves, the ones that pay for all the waiting, come after long periods of preparation. Bases form, trends rest, weak hands are shaken out, and all of this takes time. If you don't give the market time, you won't be there when it finally moves. Action buyers also poisons the mind. It turns trading into gambling. Each trade becomes a small emotional event, a hit of hope or fear. Before long, the trader is no longer reading the chart. He's reacting to his last trade. Have you ever noticed how impatience today creates confusion tomorrow? The correct mindset is simple but not easy. You wait. You observe. You conserve your energy and your capital. And when the market lines up, trend, volume, timing, you act without hesitation. That's the irony. The patient trader is the most aggressive at exactly the right moment. I never believed in predicting markets. I believed in following them. And you can't follow something if you're always trying to lead it. The market sets the pace. Your job is to fall in step, not to drag it forward. Wealth in trading is built the same way as wealth anywhere else, by avoiding unnecessary risk and pressing your advantage when it appears. Action bias flips that logic upside down. It risks money when there is no advantage and hesitates when the advantage finally arrives. How many times have you been exhausted from too many small trades, only to miss the one move that mattered? The hardest thing I ever learned was to stop trading. Not forever, but until the market gave me a reason. Once I learned that, my equity curve changed. Not because I became smarter, but because I became quieter. The market rewards the man who can wait with a clear mind and act with a firm hand, and most traders never realize that the urge to act is often the very thing standing between them and consistent profits. Trading is a business of selection, not participation, and that truth runs against every instinct a man brings into the market. Most traders come in thinking they are paid for activity. They believe the more involved they are, the more professional they look, and the more money they should make. But the market doesn't pay salaries. It only pays for being right at the right time. Have you ever noticed how the busiest traders are often the poorest ones? I learned early that being in the market is not the same as being in the right position. There is no prize for showing up every day with a trade. The tape does not reward enthusiasm. It rewards discrimination. A trader's real job is not to trade often, but to trade selectively. That distinction alone separates the professional from the crowd, even if both are looking at the same charts. Participation feels productive. Selection feels slow, and that is why most men choose participation. They want to feel involved, to feel like they're working. But trading is not manual labor. It's closer to hunting. You don't fire at every rustle in the bushes. You wait until you clearly see what you're aiming at. Ask yourself honestly, are you trading because the setup demands it, or because you feel uncomfortable watching without acting? The market offers endless movement, but very limited opportunity. Price can move up and down all day, long without presenting a trade worth taking. Selection means filtering out 90% of what you see and acting on the small remainder that aligns with trend, structure, and timing. Most traders do the opposite. They trade 90% of what they see and wonder why their results are inconsistent. I didn't make money by trading everything that moved. I lost money doing that. I made money by learning what not to trade. That lesson came after years of action, losses, and frustration. Every loss taught me that the market punishes the man who cannot say no, and saying no is harder than clicking a button. Charts are full of temptation. Small breakouts, tiny pullbacks, minor patterns that look important in the moment but mean nothing in the larger picture. Selection requires perspective. It requires stepping back and asking, where is the real pressure? Where is the imbalance? If you can't answer that clearly, you have no business being in the trade. Isn't it strange how clarity usually comes when you're not already committed? Participation-based trading turns a man into a servant of price. Every tick demands attention. Every candle feels like a signal. The trader reacts instead of decides. Selection-based trading does the opposite. It puts the trader in control. He decides in advance what he's waiting for and ignores everything else. That kind of discipline doesn't feel exciting, but it protects capital and sharpens judgment. Capital is finite. Opportunities are not. That's a point most traders get backward. They treat capital as something to constantly deploy, as if unused money is wasted money. But capital preserved is capital prepared. Selection means you don't spend bullets on low probability shots. You wait until the target is clear and close enough to matter. A man who understands selection knows that missing trades is not a sin. Overtrading is. The market will always be there tomorrow. Your capital might not be if you keep forcing trades today. Have you ever noticed how the market often moves best right after you stop chasing it? Selection also applies to time. Not every market environment is worth trading. Sometimes volatility is too low. Sometimes trends are unclear. Sometimes price is trapped in ranges designed to exhaust impatient traders. The man who participates anyway is donating liquidity to the market. The man who selects waits for conditions that favor him. I used to think confidence came from constant engagement. Now I know it comes from restraint. The more selective I became, the fewer decisions I had to make, and the clearer my thinking became. Trading became simpler, not more complex. The market didn't change. I did. Selection is not hesitation. When the right opportunity appears, there is no debate. You act. But that action is powerful precisely because it is rare. It is backed by preparation, not impulse. That's the kind of trade you can sit with, because you know why you're in it. Most traders want to feel busy. Professionals want to be effective. One is participation. The other is selection. And the market, without ever saying a word, makes it very clear which one it rewards. Selection means you accept boredom as part of the job. You accept that most days your edge does not appear. You accept that waiting is not wasted time but necessary time. That acceptance alone puts you ahead of the crowd. The market doesn't ask how hard you tried. It only reflects how well you chose. And choice begins long before the order is placed. That's why the real work of trading happens when you're not trading, watching price, waiting, knowing that participation is easy, but selection is rare. Boredom is often a sign of a healthy market stance, though most traders would argue the opposite. They believe boredom means something is wrong, that they're missing opportunities, that money is being made somewhere without them. But boredom, in trading, is usually the quiet proof that you are not forcing yourself into bad positions. Have you ever noticed how discomfort shows up the moment nothing is demanding your attention? The market has a way of training men poorly. It conditions them to think excitement equals opportunity. Fast candles, sudden moves, sharp reversals, all of it looks important, urgent, alive. And when none of that is happening, the trader begins to doubt himself. He checks more charts. He lowers his standards. He invents trades. But boredom is not the enemy. Impatience is. I learned that when I was young, I confused stimulation with progress. If I wasn't in a trade, I felt unproductive. If I wasn't watching every tick, I felt careless. But that mindset only led me to trade marginal setups, the kind that look acceptable in the moment and expensive afterward. The market taught me that boredom was simply the space between real opportunities. Why should that space frighten you? A healthy market stance means you are aligned with conditions, not fighting them. When trends are unclear, when price is chopping sideways, when volume is drying up, the correct response is not activity, it is restraint. And restraint feels like boredom to the undisciplined mind. The trader who understands this doesn't complain about dull markets. He respects them. Boredom is also a signal that you are no longer emotionally attached to every fluctuation. The market moves, but you don't feel compelled to respond. That distance is valuable. It keeps you objective. It keeps you from marrying opinions or reacting to noise. Have you ever noticed how emotional traders are never bored? Because they're constantly entertained by their own anxiety. When you are bored, you are not being pulled by the market. You are standing on your own ground. That is a position of strength. The trader who cannot tolerate boredom will always be controlled by price movement. He becomes reactive, and reaction is the enemy of sound judgment. There were periods in my trading when weeks passed without a single trade. At first, that felt unbearable. I thought I was losing my edge. In reality, I was sharpening it. By not trading, I preserved capital, mental clarity, and patience. And when the market finally offered a genuine opportunity, I was ready, not exhausted from constant decision-making. The market does not operate on your emotional schedule. It does not provide steady action to keep you engaged. Most of the time, it is setting traps, testing patience, shaking out weak hands. Boredom is often the market asking you a question, can you wait? Most traders answer no without realizing it. A bored trader with discipline is dangerous, because he is selective. He has nothing invested emotionally in the market's small moves. He is waiting for imbalance, for pressure, for confirmation. He is not guessing. He is observing. That kind of waiting feels empty to the impatient, but it is full of purpose. Boredom also reveals whether you trust your process. If your plan says there is no trade, and you feel restless anyway, then your plan is not the problem. Your discipline is. The market is not responsible for entertaining you. It is only there to transfer money from the impatient to the patient. Have you ever asked yourself who benefits when you break your rules out of boredom? Many traders fear boredom because it forces them to sit with their thoughts. No trades to distract them. No excitement to mask uncertainty. Just time and observation. That's uncomfortable. But it's also where growth happens. You start seeing patterns more clearly. You start recognizing when something is truly different instead of merely noisy. Boredom is often the quiet companion of consistency. When trading feels calm, even dull, it usually means you are not over-leveraged, not over-committed, not emotionally stretched. The equity curve grows slowly, unevenly, without drama. That's not appealing to the ego, but it's appealing to the account balance. The man who needs constant action will always trade the middle of moves, the worst location, the place where risk is high and reward is uncertain. The man who accepts boredom waits for edges that are clear enough to overcome his natural reluctance to act. I learned to welcome boredom as confirmation that I was doing my job correctly. If nothing met my criteria, I stayed out. No arguments. No adjustments. The market did not need my participation to function, and my capital did not need to be exposed without reason. Most mistakes happen when boredom is mistaken for opportunity. A small breakout looks bigger than it is. A random candle feels meaningful, and before long the trader is in a position he cannot explain except that he didn't want to sit still. Boredom keeps you clean. Clean of bad trades, clean of emotional residue, clean of unnecessary risk. It gives you room to see the market as it is, not as you wish it to be. And when boredom finally breaks, when price aligns and pressure builds, the contrast is obvious. The best trades arrive after long periods of inactivity, and that truth is invisible to the impatient trader. Most men only notice the trade itself, the entry, the movement, the profit or loss. They don't notice the weeks of nothing that came before it. They don't respect the silence that prepares the move. Have you ever looked back at your best trade and realized how little you did before it appeared? Inactivity feels unproductive to the untrained mind. A trader sits in front of charts day after day, watching price go nowhere, feeling like time is slipping away. He thinks opportunity is passing him by, but what's really happening is preparation. The market is building structure. It is transferring shares, absorbing supply, wearing out the impatient. And none of that pays immediately, which is why most traders lose interest before the real move begins. I learned that the market spends far more time setting up than it does paying out. The payout is brief, the setup is long. If you cannot sit through the setup, you will never be present for the payout. That is not philosophy. That is mechanics. Yet most traders act as if the market should reward them on demand. Inactivity tests your belief in your edge. When nothing is happening, doubt creeps in. You start questioning your analysis, your rules, your experience. You think maybe you should be doing more, adjusting more, trading more. But the best trades do not need persuasion. They present themselves clearly after patience has done its work. A stock does not move because you are ready. It moves because conditions are aligned. Accumulation takes time. Distribution takes time. Trends rest before they continue. All of this looks like inactivity on the surface, but underneath, pressure is building. Have you ever noticed how the strongest breakouts come from charts that bored everyone for months? The trader who cannot tolerate inactivity will always enter too early. He buys before the base is complete. He sells before weakness is confirmed. He is technically correct in direction, but wrong in timing. And timing is everything. Being early is indistinguishable from being wrong when capital is at risk. I made my best money waiting through dull markets, not exciting ones. The exciting markets were crowded, emotional, and unpredictable. The dull ones were quiet, controlled, and honest. In those quiet periods, I could read the tape without interference. Volume spoke clearly. Price behavior made sense. There was no urgency to act, only information to collect. Long inactivity also protects your mind. Every trade carries emotional weight. Too many trades in too short a time dull your perception. You stop seeing the market clearly. Inactivity keeps your judgment sharp. When the moment finally arrives, you are not worn out from decision fatigue. You are fresh, alert, and decisive. Most traders believe success comes from constant engagement. In reality, it comes from conservation, of capital, of focus, of confidence. Inactivity conserves all three. It allows you to avoid small losses that add up, the kind that don't destroy accounts but quietly erode them. Have you ever wondered why your account bleeds during normal markets but jumps during rare ones? The best trades feel different because they follow inactivity. There is clarity. There is alignment. The trade makes sense not just technically, but emotionally. You are not trying to force anything. You are responding to something that has matured. That's why those trades are easier to hold and harder to second. Guess. Inactivity also teaches humility. It reminds you that the market does not exist for your entertainment. You are not entitled to daily profits. You earn them by waiting until conditions favor you. That mindset alone filters out many bad decisions before they ever reach the order button. I used to think that waiting meant missing out. Now I know waiting means opting in only when the odds justify it. There is a difference between missing a move and avoiding a bad trade. The market does not penalize you for not trading. It penalizes you for trading poorly. Long periods of inactivity are where discipline is forged. Anyone can trade when the market is obvious. Very few can stay disciplined when nothing is happening. That is why inactivity is the gatekeeper. It keeps the impatient out and lets the prepared through. When inactivity ends, it does not whisper. It announces itself through changes in behavior, volume expanding, ranges breaking, trends resuming. The trader who waited recognizes it immediately because he has been watching without interference. The trader who stayed busy is distracted, skeptical, late. The irony is that inactivity makes trading feel slower but results faster. Fewer trades, larger impact, cleaner execution. The equity curve improves not because you traded more, but because you traded less. The market rewards the man who can sit quietly while others grow restless. That waiting is never wasted. The market moves on its own schedule, not yours, and that single fact is responsible for more frustration and losses than most traders are willing to admit. A man comes to the market with a plan, a timetable, maybe even a need. He wants action today, results this week, confirmation now. But the market has no awareness of your expectations. It doesn't speed up because you're ready, and it doesn't slow down because you're afraid. Have you ever noticed how the market seems most stubborn? Precisely when you're most impatient. Every trader learns sooner or later that wanting a trade does not create one. The chart does not bend to desire. Price does not respond to urgency. The market unfolds according to forces far larger than any individual participant. Accumulation takes as long as it takes. Trends emerge when pressure reaches a breaking point, not when you decide it's time. Fighting that reality is exhausting, and exhaustion leads to mistakes. I spent years trying to trade on my schedule. I wanted quick resolutions, fast feedback, immediate clarity. When the market didn't provide it, I grew restless. I interpreted slow movement as a personal challenge, as if the market were testing me deliberately. In truth, it was doing what it always does, moving in cycles that ignore human impatience. The market's schedule is built around preparation, not reward. Most of the time is spent building conditions that make a meaningful move possible. This preparation phase looks dull, random, and unproductive to those who don't understand it. That's why so many traders act at the wrong time. They confuse waiting with failure. Have you ever wondered why the move finally comes only after you've given up on it? When you impose your own timeline on the market, you start forcing trades. You shorten your holding periods. You lower your standards. You interpret weak signals as strong ones because you're tired of waiting. The market doesn't punish you for wanting results. It simply ignores you while you make poor decisions. Understanding that the market moves on its own schedule changes how you manage risk. You stop overcommitting early. You stop assuming that today must be the day. You allow trades to develop instead of trying to predict them. That patience reduces stress and improves execution, even though it feels slower on the surface. Most traders think timing the market means predicting when something will happen. In reality, it means being ready whenever it does. Readiness is different from urgency. Readiness is calm. Urgency is emotional. The market rewards one and exploits the other. There were times when I watched a market for months without taking a position. That wasn't inactivity, it was preparation. I was learning its behavior, its rhythm, its character. When it finally moved, I didn't hesitate, because I wasn't rushing. I was responding. That's the difference between trading with the market and trading against it. The market's schedule also teaches humility. No matter how experienced you become, you are still reacting, not controlling. The moment you believe the market should move, because your analysis says so, you've already stepped out of alignment. Have you ever noticed how the market often moves cleanly only after it has frustrated everyone involved? Impatience narrows perception. When you want something to happen, you see only evidence that supports the desire. You ignore warning signs. You rationalize poor entries. The market doesn't need to trick you. You trick yourself by insisting on your own timeline. When you accept the market's schedule, trading becomes less personal. You stop taking delays as insults. You stop feeling pressure to prove something. You understand that no trade today does not mean no opportunity ever. It simply means the conditions are still forming. This mindset also changes how you think about profits. Instead of expecting steady, predictable gains, you accept that profits come in bursts, long stretches of nothing, followed by sharp periods of movement. That rhythm is natural. Fighting it only leads to overtrading during quiet periods and underperforming during active ones. The trader who respects the market's timing stays solvent long enough to catch the moves that matter. The trader who demands constant action burns capital while waiting for the market to comply. One adapts, the other resists. I learned that the market is never late. It arrives exactly when conditions allow. Your job is not to hurry it, but to be prepared when it arrives. Preparation requires patience, observation, and restraint, all of which feel uncomfortable when you're focused on the clock. Once you stop asking when and start asking whether, your decisions improve. Is the market ready? Is the setup complete? Is the pressure visible? Those questions align you with the market's schedule instead of your own. The market does not explain its timing. It does not warn you when it is close. It simply moves, and only those who waited without forcing themselves into premature trades are positioned to benefit. And waiting is easier once you accept that the schedule was never yours to set.